Hey folks, it's Brad Briggs and welcome to a special Q&A session with Nathan Slaughter, Chief Investment Strategist of High Yield Investing. Today we're going to be discussing some of your most pressing questions about the market, investing strategies, and some of our own portfolio holdings. Let's dive in. Okay, Nathan, I hope you're ready because I'm going to fire away here. Charles is a relatively new investor and he says he's been a subscriber for about 2 years and he wants to know what you think about AI as it relates to investing. Specifically, is there any merit to this and do you recommend a way to take advantage?
Charles, that's a great question. I'm going to mainly hit the highlights on these so we can cover more ground. There's no doubt that AI, just like 5G or cloud computing before it, is radically transforming many different industries. It's a disruptive game changer that will create huge economic impacts. I hesitate to even put a number on it. Some are forecasting this could be well over $1 trillion market by 2030. But this evolution is still in the early stages, especially when it comes to stock picking. These platforms are far more geared to language than financials. One day, maybe, but we're not there yet. And since few of the players in this space pay dividends, AI isn't exactly compatible with high yield investing at this point. But I'll definitely be keeping an eye on future developments.
All right, so next up, we've got someone writing under the name Investing for Income, and they want to know what's going on with VF. It's down about 15% since we added it to the portfolio. That happened back in April, and it's a dividend aristocrat. So, what's the deal?
VF owns a collection of active lifestyle brands, including North Face and Timberland. Most of these products are gaining traction with consumers. 10 out of its 12 brands produced positive sales growth last quarter. But the core Vans lines continue to slump, and I think that's a big reason why the stock has struggled lately. But we knew going in that these turnarounds take some time. They don't happen overnight. And there are growth initiatives underway. Looking ahead, management's forecasting 5+ billion in cumulative cash flows over the next 5 years. And it plans to return every penny of that to shareholders through dividends and buybacks. For now, there's also some excitement around the recent hiring of a new CEO with a great track record. So I'm being patient.
All right, so next up is Jeffrey, and he's got a question about a REIT that I think will be beneficial for a lot of folks. He wants to know, why is the PE ratio for DLR so high? Now, that's Digital Realty for folks that don't know. We had one back in March, and it looks like it's up about 35% since we added it, and it's yielding about 4% right now.
Hey, Jeffrey, good to have you on board. PE ratios can be a useful yardstick for measuring valuation, but it's not a one-size-fits-all tool. PE doesn't work too well for real estate trusts and master limited partnerships and a few other groups. That's because these businesses own assets that can rack up hefty depreciation charges, which can cloud earnings and understate how much cash the company's truly bringing in. That's why most analysts pay closer attention to metrics like operating cash flow or distributable cash flow. Digital Realty's data centers are a perfect example. Net income's only projected to be around $300 million this year. But when you add back non-cash accounting entries, the business will really generate $1.9 billion in profits, about 6 times as much. I hope that clears things up.
Okay, so next question is from Greg, and he's asking about the merger between MMP and OKE. And for people that may not remember, that's Magellan Midstream Partners, an MLP that's our longest holding. We've held that since 2005, and it's up close to 600%. So a lot of longtime subscribers probably want to know what they should do with this. One Oak recently came out with an offer to merge the two companies. So Greg is writing, what's your advice concerning these two stocks?
Great question, Greg. The proposed merger between Magellan and One Oaks hit a snag due to tax concerns from a few big shareholders. Normally, acquisitions are tax-free events, but with master limited partnerships, that's not the case. So when this deal is finalized, it's going to create a tax liability for Magellan shareholders. Some subscribers have considered selling now before the transaction concludes to avoid the tax bill, but that won't work. Whether you exit now or wait for the deal to close, it'll be treated as a sale either way. Uncle Stam is still going to get his cut. For those who've held the stock a long time, like we have since 2005, This tax could wipe out most of the 22% premium that was linked to the buyout, especially since a good chunk of the profits might be taxed at ordinary income tax rates rather than capital gains rates. But tax concerns aside, there are some compelling strategic motivations behind this deal. These two energy infrastructure giants could be much stronger together than they ever were separately. Whether the deal proceeds or not, I won't lose too much sleep. Magellan's already given us a 550% return and increased its dividend 58 times since we first bought in. The company's perfectly capable of standing on its own. But unless something changes, I plan to stay the course and ultimately exchange my Magellan shares for ONEOK once the deal's completed.
All right, Nathan. So, last question. This one comes from Narasaman, and he wants to know what you think about OZK. He says he read a report naming that bank as one of the ones with a large percentage of loans secured by office properties. So, he wants to know your opinion of the report and the potential risk to OZK.
That's true. Bank OZK may be headquartered in Little Rock, Arkansas, but it's helped finance more Manhattan skyscrapers than Citigroup. Construction and development loans account for about 40% of the bank's portfolio. That specialty's paid off. OZK has been named the best bank in the nation 13 times. But we're starting to see mounting signs of stress in the commercial property markets, and more defaults could be coming industry wide. Banks are already setting aside larger loan loss provisions just in case. Bank OZK is a very disciplined lender that takes steps to mitigate risk, and right now, credit quality is outstanding. Just a tiny percentage of its loans, about 0.15%, are non performing. It's also raised dividends 52 quarters in a row. But I'd rather be proactive than reactive here. And since the stock's already reached my target price, out of caution, I put in a protective stop loss just to lock in profits.
Well, that's it for today, folks. I hope you found it helpful. If you did, don't forget to give us a like and subscribe below. And remember, you can always email Nathan or myself with your questions. Until next time.